If you walk into any bookstore, there are several different books that you can pick up that talk about the subject of how to gain access to capital. But let me let you in on a little bit of a secret. The banks aren't interested at all in your report card. They're interested in two different documents, an income statement and a balance sheet. Today we're going to talk about what those look like. There are actually three types of income statements and balance sheets. The first one is a poor type of income statement and balance sheet. The next one is a middle class type of income statement and balance sheet. And the last is a rich type of income statement and balance sheet. Today is going to be kind of a good treat for you because of the fact that you get to peek inside of a banker's mentality when it comes to whether to give you access to capital or not. Before we dive into the three types of income statements and balance sheets, I think it'll be very important for us to define what these two terms actually mean. Let's first define what an income statement is. An income statement is one of a company's core financial statements that shows their profit and loss over a period of time. Simply put, an income statement just shows a company's income and expenses. Let's now define what a balance sheet is. The balance sheet displays the company's total assets and how these assets are financed through either debt or equity. Simply put, a balance sheet displays a company's assets and liabilities. Let's take a look at this first type of income statement and balance sheet, which is the poor type. If you view this income statement, you see there's an income and expenses section. In the income section, there's a salary because there's a job present. In the expenses section, you see taxes, rent, food, transportation, and clothes. Now, and also you see on the balance sheet, there's nothing there at all. Interesting. Now, when the job produces the income in the form of salary, it then pays for the expenses and the income goes right out the door. And also, here's another observation. If the salary of the job is taken away, the expenses still remain. No banker will give you access to any type of capital, this type of income statement and balance sheet. Now let's look at the middle class type of income statement and balance sheet. If you look at this, you have a job which generates an income in the form of a salary. Then you have the expenses, which is taxes, a mortgage payment, car payment, credit card payment, school loan payment. Now, in this example, the expenses and the liabilities are essentially the exact same. So when the income comes in from the job, it loops down to the liabilities, then loops back up to the expenses, and the income goes right back out. Also, as you can see on the balance sheet side, there's no interaction with the asset section at all, just a liability section. And also, if the salary is taken away, the liabilities and the expenses, which is essentially the exact same, still remain. With this type of income statement and balance sheet, a banker will not give you access to any capital. Now let's look at the rich type of income statement and balance sheet. In the income section, you'll see there's rental income, dividend, interest, and royalties. In the expenses, you'll see there's taxes and mortgage payment. In the balance sheet section, you see on the asset side, you see real estate, stocks, bonds, notes, and intellectual property. In the liability side, you see mortgage, consumer loans, and credit cards. The difference between the other two types of income statement and balance sheets is the richest income comes from the assets and not in the form of a job, okay? Now, when those assets generate income, it comes in the form of rental income, dividend, interest, and royalties. Now, you may say, hey, but they have expenses and liabilities. You are correct, but that income coming into the income section from the assets have already accounted for those expenses and liabilities. In other words, that income that's coming from the assets into that income section is the net income, not the gross income. So in other words, those expenses and liabilities have already been paid for. A banker will throw money at this type of income statement and balance sheet all day long. Now, the question that you may be asking is, when the bank is making a decision on who to partner with, what do they look for when it comes to saying yes to someone and giving them access to capital? Well, here's the answer to that question. How is their money secured? If the business deal goes bad, how can they recoup their investment? Now, you be the banker. Which income statement and balance sheet would you feel the most comfortable with in recouping your investment? Most likely, it would be the rich income statement and balance sheet. Thank y'all for watching Little Old Me, your partner. If you want to get some additional clarity on the subject of access to capital, you may want to watch my previous two videos. One is named Assets versus Liabilities, and the other one is named The Cash Flow Quadrant. That's really going to rock your skull a little bit. And guys, if you could subscribe to our channel, we're trying to get our subs up. We're on every platform known to man. We're talking about Facebook, Instagram, Twitter, Rumble, Parler. We're on all those platforms. And you know I look fresh, cold, clean in my ice cold drip. Y'all see that thing? Holla at your partner.